Hi, my name is Daniel and you're watching Unrivaled Investing. This is a no-hype, mission-focused channel to try to find you exceptional companies and unrivaled investments. Usually I do videos, talking about potential multi-baggers, types of companies that I think can go up, potentially hundreds or thousands of percent over time. Those are the types of companies that I'm looking for. But today I'm actually doing a warning video, a warning for all those index and passive investors that are out there saying, hey, things may not go as well as you'd expect. There might be rough periods for you in the future. Index investing isn't as easy as you might think it is. And that's what this video is about. This video is about a warning for all the passive investors out there, the folks that own, let's say, the US indices like the S&P 500 or the NASDAQ, like QQQ, so SPY or QQQ. Like, this is a warning video, something for you, food for thought for you to think about if you're just passively putting money away in these indices over time, something that you should consider, something you should think about over time. Now, the return for these major indices, particularly the US indices, over the last 12 months have been phenomenal. You look at like the S&P 500 is up something like over 50% over the last 12 months. The NASDAQ's up over 90%. The Russell 2000, the smallest 2,000 companies, they're up like over 90%. So 50% for S&P, 70% for NASDAQ, 90% for the smaller companies, the Russell 2000. Part of this is because it's sort of a timing thing where March of 2020 was sort of people were panicking about the pandemic. And so you're sort of comparing it to a low base. But there has been an incredible rally since the bottom in March 2020, where March 2020, early April, where you had an incredible amount of stimulus also step in, both fiscal and monetary, sort of saying pedal to the metal, we'll do whatever it takes to sort of make sure things are right. And that liquidity flooded into the capital markets, and that's the reason why you've had these incredible returns for passive investors. But the problem is, and this is the real challenge here, is that a lot of passive investors are looking at these returns and they're starting to think, hey, this is easy, or the amount of money that I've made, this is normal. This is not normal. For most people, they don't realize is that the amount of money made in the past year is more than you make in some decades investing in the underlying indices. What? The money made this past year in these major indices can be more than you make in a decade owning these same indices. And that's part of the big warning that I want to call out, that you don't always have periods like you've had this past 12 months. And I also want to talk about what can you potentially do about it if you are going to enter in, let's say, choppy waters for years at a time. Now, unfortunately, these exceptional returns have attracted, investors and a lot of people on the sort of the sidelines. Maybe it's their first time getting into the marketplace using something like, some of these gamified investing apps or speculating apps, trading apps, to sort of get into the market for the first time. And so you have people buying meme stocks, buying stocks that they see on a Reddit board. They see, hey, a YouTuber's pumping it. Oh, I should get into it. And so it's really an unfortunate consequence when the reality is successful investing is grounded in fundamentals. And if you don't do that, you start seeing the stories like, I've seen, unfortunately, where you look at, like the Reddit boards where I'm seeing folks buying the AMCs, the GMEs, and they've lost, over half their life savings. I've seen some posts where someone said, oh, man, I've lost 5 figures. I've lost 6 figures. I've lost more than half my life savings. I feel so bad. I'm seeing things like this, and it's brutal. Like one of the comments that really ate at me was when someone posted in one of these main chat forums, they said, I feel like I've let my family down. And there's a lot of people like that right now that are making the mistake of speculating in things that honestly they don't know much about. And you're swimming in deep waters here. There's shark infested waters. You should know what you're doing. Otherwise you can get hurt. And that's, I'm afraid, is what's happening to a lot of people. A lot of people are getting caught up with the FOMO and the consequences. Yeah, there will be a few heroes. There will be a few stories of people, that light a match and go through the dynamite factory and don't blow up. But there's a lot of instances of people posting things like, I feel like I've let down my kids, I've let down my family. And just that if you have some sort of soul inside, how can that not eat at you hearing something like that? And so that is acknowledging that I'm sure there's plenty of Wall Street that do not have souls, and they're like, ah, suckers. But for me personally, I'm thinking like, this is just brutal. It's really sad. And in fairness, I think it's preventable too. Like, you can't just speculate willy-nilly money in stocks without thinking about the underlying valuation. And that's why, every time I'm doing one of these videos, usually I'm trying to call out like, hey, here's a hypothetical valuation framework that I'm thinking about. Look, it's hypothetical. You can play around with your own assumptions. But this is like, I've called out situations where I'm like, even in my best case, I just don't see these valuations. And in several of them, like BigCommerce, Multiplan, and C3.ai, in each of them, I was like, look, I don't understand how it's anywhere near these valuations. I'm trying to warn folks like, hey, maybe you should get a grip here. And subsequently, each of those are down more than 50%. So this is, it is worthwhile to like know the fundamentals that back up the stock, because at the end of the day, these things aren't just pieces of paper. These aren't just trading things. There should be inherent value to it. And if you don't combine a inherent fundamental value versus the stock price, you're potentially going to get burned. And so it's burning enough people that I'm afraid they're going to also reach another wrong conclusion. First it was like, hey, things are so easy. The market's just going up because, it's been just rallying like crazy since the March 2020 lows, that they thought, oh, I can get rich in, speculating in meme stocks. That's not the right conclusion. Now folks are starting to get burned, and they're starting to think, well, you know what? I'm just going to move my funds. Active investing was too hard. I'm going to move my funds to passive investing. I'm going to buy the S&P 500 SPY index, or I'm going to buy another index of hypergrowth names, maybe like one of Kathy Wood, her funds, ARK funds. Oh, she's done really well the last few years. I'm just going to buy these hypergrowth names. It doesn't matter what the valuations is, or I'm going to buy the NASDAQ, or I'm going to buy the Russell. It's done so well this last year. Why not? But investing, the reality is investing is not easy. Especially passive investors need to understand that these types of returns are not typical, and there are long periods, potentially decades, where passive investor returns go nowhere. For example, and I'm going to go through a couple of quick examples just for you to mentally like play around with in your head. If you zoom, you got to look. You can't just look over a 1 year period. You can't just look over a few months. You need to think about this over a lifetime, over multiple lifetimes. You start looking back at the Dow Jones Industrial Average back in the 1920s. You buy it at its peak in 1929. It would have been decades before you've made back your money. You've had the depression since then, and a dramatic market rally, and then a crash again. It would have been decades before you were profitable. Not one decade, multiple decades before you were in the green again. And then another example is if you bought, let's say, the S&P 500 in like 1966 or the mid to late 60s, it would be about another decade, a little over a decade before you made back your money. You would be dead money for over a decade, years of just going nowhere, choppy waters where things you could buy and you're just in the red for years. So passive investing is not the solution. Another example is not necessarily the solution for folks that need to generate returns over time. Another example is if you bought, a lot of folks remember the dot-com boom, but it did lift a lot of boats where not only did the NASDAQ get wiped out, drop something like 80-90%, from its peak, but if you looked at the S&P 500, the 500 largest companies here in 2000, it was dead money until you'd have some wild rides. But if you went, let's say, all in the index in 2000, it wouldn't be until like 2014 until you break even or in the money again. So once again, over a decade of just sort of terrible ride where it's like, oh my gosh, this is a terrible experience. So what are you supposed to do? Especially when, like the alternatives, you're thinking, wait a second. So active management, I'm buying stocks myself. I don't trust myself to do it. Like that's not a great solution because I end up buying meme stocks. If I trust myself with an active manager, a lot of active managers generally underperform. So like what am I supposed to do? So like what are the different answers? I do have some sort of thoughts here, and you probably won't like some of them, but like let's focus on like the first initial answers, the answers you probably won't like, and then focus on the things that you might like and things that you can control. So the first answer is like recognizing that things might go nowhere for decades, go nowhere for years at a time, especially after you've had this monster rally in the underlying US indices. You need to set lower expectations. Nobody likes to hear that. Everyone wants to, marry a model. You got to set lower expectations. All right. I'm reminded of that quote from The Rock, the movie, where it's like, you can't always, marry the prom queen. And he's like, my wife is the prom queen. So it's like, you got to set lower expectations, folks. Like, this is the challenge with, markets that are lofty valuations, that are priced based on very low interest rates, is that you might have zero return for a passive investment strategy for years, potentially decades. The next is to live below your means. That's effectively saying, hey, try to have savings each month, so that way you can be allocating it to something that can invest and compound for you over time. Now those are the first two sort of initial thoughts, and those are the sort of the difficult medicine that I think a lot of people have to swallow. But then for the more enterprising folks, the folks that are looking to take sort of the control and maybe put it in their own hands of what you could potentially do, because the live below your own means is sort of saying, look, if you have to do something with it, maybe at worst you do dollar cost averaging. I personally don't like that approach with the indices, because you could potentially be going nowhere for a decade and just dollar cost averaging in something that doesn't go anywhere. That's not really a fun ride. So then, so I've done the tough medicine for the folks that are saying like, look, that's the approach I'm going to do. And even that might not work for a lot of folks, because like, for example, I had this retired professor calling me in the middle of the panic, the financial crisis in March 2009, and they said, I just blew. They were a passive investor, and they were holding on to a bunch of indices, and they had a couple of high growth ETFs that they were also invested in, much like Kathy Wood's ARK funds, and they were just getting completely crushed in the great financial crisis, and they blew out. He just blew out of it. At the effectively near the bottom in March 2009, saying, hey Daniel, what do you think I should do? And at that point, I was just like, dude, like that's the whole problem that you have with passive investing is will you actually keep at it, or will you panic and get out of it at the worst possible time? And so that's why I think for the folks that are more enterprising, this is something to consider, and that's what I'm about to go through, is sort of a multi-pronged strategy. And this is my own personal strategy. Is one is to try to find exceptional companies. Each month I'm trying to find potential multi-baggers, trying to find every day. The reality is I'm looking out for the types of companies that you think are potential game changers, companies that you go, oh, well, this is just obvious. Maybe it's unrivaled. Maybe it has the right to win. Maybe they're defining a new category, a new industry, where it's saying, wow, I used to have to go to Blockbuster and get movies, and this was a terrible experience with late fees, and now I got this whole Netflix thing. You want to find these things that are redefining a category, and that just can compound long periods of time, an unrivaled value proposition. And when you find these potential exceptional companies, they have the potential to go up hundreds or even thousands of percent over time. And so for those types of companies, my approach is like each month, allocate, squirrel away some capital and put it into one of these types of exceptional potential multi-baggers. That's my approach. So each month, if you're able to plant some seeds, and eventually some of them are going to be flat, some are going to be duds where you lose them a little bit, but some of them can grow up to be huge trees and just do exceptionally well. So that's like the first thought process, is like each month, look for, make a point of allocating capital into at least one idea that you think has this multi-bagger potential, something that can radically outperform the underlying index. Even if you're in a period where the market goes nowhere for a decade, find something that you think can be up hundreds or even thousands of percent, because this business model is set to dominate, and critically, the valuation is fair. And that gets to the second point, is that I try to be opportunistic with my purchases, because you can't just say, hey, this company is the best thing since sliced bread. You need to actually say, well, wait a second, like, am I paying a reasonable value for this? There are plenty of exceptional companies that also went nowhere for a decade. Coca-Cola in the early 2000s over the next decade, Walmart. You can go through so many different instances where if something's priced super expensively, it can go nowhere, even if their earnings, Microsoft from 2001 to 2013, effectively went nowhere, even though their earnings continue to grow. So you need to find situations not only that are exceptional, but ideally they have a fair price. So, exceptional company is the first one. Plant those seeds each month. The second part is be opportunistic with trying to find things like, ooh, I think this is a more attractive valuation, the risk reward. I'm always calling out how I'm trying to find things with a favorable risk reward where it's like maybe logically downside of maybe 10-20% and upside of 200%. Now, of course, things can go way higher or lower than a logic framework, but working from a logical framework is the first step in my mind to finding these types of things. It's a framework in which to invest. Another aspect is to do some sort of hedging strategy, and that does take a lot of time. I do have an active sort of hedging strategy. I've talked about it. Journey subs know about that, where it does involve a lot of work. It's not for everybody, but it's for those folks that are a little nervous or folks that want to be able to sort of protect themselves from potential market collapses. So that is one that is I would say a third tool that you do have in terms of dealing with potentially choppy markets that go drop down 20% up, recover, then drop another 30, that just go nowhere for years, for decades. And then I think the fourth component is that there are actually some companies that, I'm going to call these the bear market busters, that they have something special about them, where they actually are anti-fragile. And that's a key concept that I loved from reading Nassim Taleb's book, Anti-Fragile, where there are some types of companies that can actually benefit from choppy waters or can benefit from stressors. They can get stronger in periods like that. And I'll do a whole separate exclusive video on that for my Unrivaled Investing Journey subscribers. If you're interested in learning about that, you go to www.unrivaledinvesting.com, click on Journey, and I have I have my whole portfolio. I update you each month with potential multi-baggers that I'm trying to buy, as well as this educational series. Like I'll do an educational series on like my bear market busters, and I'll do that later this week on like the types of companies that I think fit that. But that, like, broadly, I think these are the strategies for dealing with potentially years of no returns for the index investors. The first two are sort of the bitter medicine: setting lower expectation, because you can't marry the prom queen, and then but my wife is the prom queen, and then the other aspect is live below your means, so that way you can squirrel away capital each month, reinvesting in something that you think, even if it's an index fund. Recognize that part of part of setting lower expectations is that your returns may not go anywhere for years. That's the trade-off. And it's not, this is not just exclusive to the US. This happens all over the world, that you have things that get expensive and then the market doesn't go anywhere for a year. This has happened in Japan for decades as well. Where index investors in Japan have had a terrible run for decades. So the first two is understanding the bitter pill, the bitter medicine. The next is sort of, if you feel like you want to take control of your own finances, additional ways to do it is one, potential multi-baggers each month. Recognize that your investing career, your investment time frame, it's going to be a journey, and that each month there might be new ideas, something to put away, trying to invest in something that can dramatically outperform the market. Another way is being opportunistic, trying to find things that have a favorable valuation, a favorable risk reward. Another aspect is hedging, which does take a lot of work. I talk about that separately. And then there's also the bear market busters, but that's a whole separate other video. I hope this video is sort of reflecting on, what the challenge is that index investors face. A lot of investors got into the market for the first time in the last few months. This is going to be a really potentially challenging period for people to wake up like, hey, markets don't always go straight up. So it is worthwhile for index investors to realize it's not just a stairway to heaven, and that you can have choppy waters, markets that go nowhere for decades. And it would be worthwhile, if you are an index investor in, let's say, the S&P 500, SPY, or NASDAQ, or Russell, for you to have a game plan for what should you do if that's going to be the outcome over the next decade. Sort of do a pre-mortem of, if that's going to happen, how do you play it? So I hope this video has been helpful for you in terms of thinking about what do you do if this is a sideways market for potentially years to come. And I hope this video has been helpful. So if it has, please make a point of subscribing, and thanks so much for watching.